Good morning, everyone. We are going to get started. It's right at 9 o'clock here. Welcome to the second day of the Lumsden and McCormick Annual Virtual Conference. We're glad everyone could join us again today. Before I turn the program over, I'm going to run through a few housekeeping items. Many of you heard these yesterday, but again, for those newcomers to the program, I'm going to review them again. I'm Maria Gamble-Corda, the Marketing Director here at Lumsden and McCormick. So first off, the webinar will be recorded, and once available, we will share the link with all the attendees, including the slide decks. And they should be available by Monday. We'll send out an email to everyone letting them know that they're up on the website. Both chat and Q&A are enabled. So you can, if you have any comments or have any questions, you can simply put them in the chat box. Any questions, we would prefer that you put all questions in the Q&A box. And you can find those on the toolbar at the, for most people, it's at the bottom of their screen. We are offering 1.5 hours of, 1 hour of CPE credit for this session. There will be 4 polling questions and a survey at the end. If you would please complete the polling questions as well as the survey. The survey will launch automatically at the conclusion of the webinar. CPE certificates will be mailed, not emailed to everyone. So you can expect those the week of December 21st, and they will be mailed to the address that you provided when you registered. I'm going to put my email in the chat, and if you have any questions about CPE credits, you can simply email me. So I'm going to turn the program over to Sarah Hopkins. Sarah is an audit principal at Lumsden and McCormick. She specializes in nonprofit organizations. And for 2 years, she is serving as president-elect of the Buffalo chapter of the New York State Society of CPAs. So Sarah, take it away.
Thank you, Maria. Welcome, everyone. We are happy to be able to host our annual Exempt conference as a virtual event this year. It is my pleasure to introduce Ed Hutton, an associate professor at Niagara University, where he teaches courses in corporate finance, investment analysis, and portfolio management, and options and derivatives. Professor Hutton has over 25 years of investment management experience, including an equity analyst, Chase Manhattan Bank, VP Investment Management, M&T Bank, and fund manager for the Western New York Business Development Fund. He holds an MBA from Canisius College and an MS in Financial Economics at the State University of New York at Buffalo. Thank you so much for joining, Ed. I'm going to turn it over to you.
Great. Sarah, thank you so much. And welcome, everyone. So I'm going to talk about what's ahead for 2021. And I have been doing this program, I guess, maybe for the last 5 or 6 years at the Exempt conference. And as I was getting ready to do this, these slides for 2021, I looked back on my slides that I had last year. Of course, I started with that as a base, and I had no idea it would be the year that we've had. Let's take a look at some of the things that that I'm going to talk about today. So what I want to do is to review basically where we are in the economy right now, which has been a very, very tumultuous year. So there's a lot of news in the economy. I want to talk about GDP. I want to talk about unemployment, inflation, interest rates, the housing markets, exchange rates, stock markets, and touch on some aspect of the local economy. Let's start with the first polling question, though. And for that first polling question, let me turn it back over to Maria.
Yep, so you can see there I launched the first polling question. If everyone could take a minute, please, and please launch it, and then we'll turn it back over to Ed. We'll give it about another 30 seconds. The vast majority of you have already answered. Thank you. Okay, Ed, we're all set. Thank you.
Okay, thank you. All right, let's start by taking a look at GDP. And so if you've attended this conference in the past, you know that I always like to start with this comparison between the potential gross domestic product and where we actually are. And a couple of things to point out. Let me just grab my pen here. So a couple of things here. First of all, what this shows here is this red line is going to be our potential GDP. And what potential GDP shows us is basically if the economy is at the level of output that it's most comfortable with. That is that, people are working the hours that they expect to work. Factories are at their capacity. This is where the gross domestic product would be. And the blue line shows the actual. Now, I always like to start with this because I think this is a good historical perspective. And a couple of things that you can see. First of all, the dark areas here are recessions. We are in a technical recession right now. So for the second and the third quarter, we've had negative GDP growth. And so that does put us in the recession area, according to the National Bureau of Economic Research. Let's take a look. So the most recent example that we had of a recession was the 2008-2009 recession. And in that case, you can see that we had a significant downturn, and it took us a number of years to be able to climb out of that downturn. So beginning in 2009, and really not until 2018, almost 9 years to get back to the same level of potential GDP that we were at. Well, this year so far, 2020, has been a record-setting year in that we've had both the largest drop in GDP ever recorded. In that case, our GDP dropped 34% in the second quarter. And of course, with the pandemic slowdown, we had this huge drop in GDP. And then we've had in the third quarter, we've had the largest increase in GDP that we've ever had. So within a time period of 6 months, we had the classic economic shock. And so we are not anywhere close to the same level of GDP that we were at. We have recovered so far about 1/2 of the loss of GDP growth that we had. So yes, we have moved back, and this has been some really strong growth that we've had in the third quarter, but we're nowhere near back to where we started with in the first quarter. So we've recovered about half of that. What do things look like for 2021? What we're looking for is to get back to some level that's going to be right around that 19 trillion, 19.5 trillion, which is going to put us back and in a positive growth. Most economists are forecasting that we're coming out of the recession, so that this recession will be severe but short-lived. And a lot of that really is based upon good news on vaccines, good news on economic activity and hiring and that sort of thing. I'm going to talk a little bit more about some of the features there, but according to the Congressional Budget Office, right now, forecast for 2021 is for growth in the economy, albeit very slow growth, somewhere around 1%, 1.2%. So that's what's forecast. So coming back, but not all the way back. Again, I talked about growth. You can see just going back 20 years that this is the chart of what things look like, and just what an anomaly. Really, nothing that's been close to this sort of drop, as I said before, 33%, and then rise of 31%. Altogether, a couple of different things here that you can see. One of the most important things I think here is to look at this third quarter number, and that was the 33% increase. Well, over that period, almost $3 trillion of stimulus into the economy. So a lot of stimulus into the economy, and the things like the enhanced unemployment benefits, the Paycheck Protection Program, and other types of things, other types of fiscal and monetary stimulus by the Federal Reserve. So a lot of money, between $3 trillion in fiscal stimulus and another $3 trillion in monetary stimulus from the Federal Reserve. So if you think about that for the third quarter, that's $6 trillion between the end of the second quarter and during the third quarter that was supplied between fiscal and monetary stimulus, on the basis of about a $19 trillion overall economy. So yes, a lot of stimulus passed through in the economy. Where are we right now in terms of that? Well, the Federal Reserve continues to be very accommodative. Jay Powell, in his latest statements, have said, yes, we're going to do the same sort of monetary stimulus. We're going to do everything we can to supply money to the economy. Where we are right now, though, on the fiscal stimulus, is that there is a lot of uncertainty as to what's going to happen, whether or not there will be a new stimulus bill that's going to be enacted prior to President Biden taking office on January 20th. And so it looks like, just looking at some of the political things that are happening, it does look like there will be some stimulus that's going to be passed. The size of the stimulus right now is going to be, looks like the discussion period is between 500 billion and 1 trillion. The Republican, the last news from the Republican was somewhere around $500 billion. On the Democrats willing to accept 1 trillion there. What's going to be the difference, and one of the major differences between those two that's going to need to be negotiated, is the extent to which money will be supplied to state and local governments to be able to recover some of the losses that state and local governments have. So that's going to be, I think, a very significant thing. So most people are believing right now that something will get done, but that it will probably be on the lower side. Well, a couple of things as we are talking about the GDP. I always like to, we live in a increasingly connected world. And so whenever we talk about the United States economy, we have to talk about the export import. And following a few quarters of relatively good news where net exports were contributing very positively to the economic growth in the United States, we can see that this is first last quarter of 2019, first quarter of 2020, that GDP was being helped quite a bit by net exports. All of that changed around in the third quarter. And so what we had was a situation in the world economy where the United States remained in a shutdown for many, many different types of things. So shut down in a lot of manufacturing. Tourism was way down here. So very few people coming to the United States to spend their dollars, and so not needing to contribute to the United States economy. And the United States being forced because of its lack of manufacturing base to have to import a lot of things, especially from countries that had recovered earlier, like China. So we had more import of medical, electronics, computers, that sort of thing. And at the same time, there was a very sharp decline in energy consumption. Nobody was driving anywhere, and factories were shut down. And so one of the most significant contributions to United States export growth had been energy. So I think as you remember, the United States had become at one point the largest net exporter of oil and natural gas. Well, when that demand has been declining, that really contributed to the fall off in the United States exports. So good news on some fronts, but on the export front, not good at all. Well, as I've explained before, whenever I try to look at the economy and what's happening in the economy, one of the things that I always like to do is to remind people that although when we talk about the economy, we sometimes think about smokestacks and big businesses and factories and that sort of thing. What really drives the United States economy, our GDP, is really based on consumers. And consumers represent about 2/3 of all of the spending in the United States GDP. And how do consumers look at spending? Well, one of the things that drives a lot of consumer spending is going to be consumers' confidence in how things will be shaping up for the following year. And so you know this from your own personal experience that you are more likely to go out and to buy washing machines and new furniture and new cars when you feel confident about the economy. Well, not surprisingly, we had a very sharp drop in consumer confidence, the largest, certainly the largest monthly drop in consumer confidence as measured by the Michigan State Survey in the second quarter. So people really lost heart right around that April timeframe. And for the most part, consumers really, although there's been some slight upticks, consumers have lost a lot of that have lost a lot of that confidence they had in the economy. So we went into a situation where we had a very sharp drop in March, April. Things have stabilized and there's been some rises and falls. But again, I would say that the consumer situation at this point is very, very tenuous. We've lost about 20 percentage points of consumer confidence. And getting that consumer confidence back is going to be one of the things that's going to make a real big difference in whether or not we're able to come out of the recession that we're currently in. For some historical context here, and I'll refer to the red line right here, which again is the Michigan, the Conference Board survey. I think shows kind of the same thing. It's a different type of survey. But in the Michigan here, you can see basically if we go back to pre-2008, 2009, this is just about the same size of the decline that we've had, right about 20 points, where consumers lose about 20 points of confidence in the economy. And you can see that when that confidence is lost, it sometimes takes quite a while for that confidence to come back. It took almost 10 years for that confidence to come back. So I think there were a lot of things that are contributing to this stalling of consumer confidence, and certainly in an election season is not one of the things that typically brings back a lot of confidence. And so there has been a lot of changes going on, and so consumers remain, I say, not confident in the economy and kind of standing off to the sidelines. If there are a couple of things that, if these change, if we do have a very successful vaccine rollout, and if there are some exceeding some expectations about the availability of vaccine and the time to vaccinations, that's something that I think could bring back some of that consumer confidence. Well, let's switch a little bit here from talking about macroeconomics to talking about the things that really I think are more personal to us, and this is going to be labor markets. So let's take a look at how the labor markets have been performing. Let's start off by following the blue line, the unemployment rate, and beginning right from the peak of the 10% unemployment rate in 2009, March of 2009, when this was part of the recession. When we came out of the recession of 2008, 2009, we had peaked at a 10% unemployment. And what we saw was a very long trend of reduced unemployment. And so we had bottomed out at 3.7% just before the pandemic. And so what we saw was almost 10 years of declining unemployment. And of course, with the shutdowns that we had beginning in the second quarter, we saw unemployment, which had been at a historical low. It never been as low as 3.7% here. So we had this dramatic drop in unemployment with the shutdowns for the pandemic here. We actually hit one of the highest unemployment rates in the second quarter of over 15%. And that has been coming back, but we're still certainly nowhere near where we were before. I'm just waiting. The numbers should have come out just a few minutes ago. I think the forecasts were to go down. We're at 6.9%. At least we were. It was just announced earlier this morning at 8:30, and I think we're down maybe to 6.7, 6.8. So a couple of things that I just did pick up with that new employment survey is that yes, the economy continues to add jobs, but the rate of growth has been slowing. In June, we had almost 4 million new jobs created. That has been declining pretty steadily, the number of new jobs. And so we were up over 4.1 million. And I believe the numbers that have just been released are for about somewhere around 260,000 new jobs. So what's happening is that, yes, employment has recovered, but what's happening is that we are kind of at this level right now, right around that 6.5%, and that rate of recovery has been slowing down a lot. And a couple of reasons for that. One has been the lack of fiscal stimulus, and the second has been the uptick in coronavirus cases, of course. And so so many things that we're trying to explain about the economy are related, either directly or indirectly related to the coronavirus, and that's certainly one of them. One of the things I think that's maybe more troubling than some of those has been a number that we had been following for quite a while, and this is the labor force participation rate. And what the labor force participation rate does is that it tells us that out of all of the people in the economy who are eligible to work, how many of those are actually working. And that rate had been falling. That rate had been falling, and it was concerning a lot of people. And beginning around 2016, the rate had stabilized and was actually beginning to rise. And as I looked at my notes from last year, it was one of the things that I had talked about as one of the positives for the economy. Well, that labor force participation rate has dropped dramatically. And I was concerned about that. And I went back and I looked at what are some of the reasons. Why is that labor force participation rate? Why did it go down so much? And I've got another slide that I want to just bring up, but let me go over to this. Whoops, let me go over to here. And so this is an interesting slide, and again, all these slides and all these slides in these data come from the Federal Reserve, the Second District Federal Reserve, and what it shows here is the percentage of job losers on temporary layoff on the right axis, and so what we can see is the almost 5.5 million people were temporarily laid off. And that number of temporary layoffs has dropped. But unfortunately, what's happened is that a lot of those temporary layoffs, which again is the reddish line here, has been replaced by permanent job losses. And I've got some more detail to share with you about what are some of the reasons why that's happening. But before I do that, it's time to go to the second polling question. And so I mentioned before that there was that there was an election that's going to impact. And so let's take the second poll question. Did the economy impact how you voted in the presidential election?
Ed, we're going to launch this poll, and once I finish, I'll share the results. But then Sarah has a question for you. So if we could answer the question before moving on to the next slide, if that's
Sure.
okay.
Yeah, go ahead, Sarah.
Okay. A question that you received, Ed, is the pandemic disrupted overall operations and supply chain channels for corporations across all industries. Do you think U.S. companies will consider bringing manufacturing back stateside and therefore increase U.S. exports?
Yes, I do. I think especially in industries that that have really been considered essential. So, for example, things like medical equipment, and I think we saw, I think we saw the example of the just being able to get things like face masks and pipettes and medical equipment and that sort of thing. And so there are certain industries I think that the United States considers essential for national security. And so there's always been manufacturing for certain defense related goods. And so the United States, because of defense considerations, requires that there be manufacturing of many essential military goods. And I think that we're starting to look at some of the United States manufacturing, even though it might not be for a plane or a tank or a military weapon, but things like medical supplies and others, that it is essential that those be made and that the supply chains be located within the United States. And so I think, yes, that we are starting to see that. And I think that that will be an important consideration going forward. One other thing is that talking about the net exports, what was the story that was contributing a lot to net exports and was a very major important part of net exports was energy. With the United States had become just not only energy independent, but also a large exporter of energy. And I think that as we go forward in the next year, there's been a lot of talk about the new administration and where the new administration will be in terms of energy and energy development. And I think that from a dollar standpoint, in terms of net export, that's going to be a really important one. So did you you want to put up the results of our poll again, Maria? There we go. So did the economy impact how you voted in the presidential election? Oh, okay, so 41% of you said yes, 59% said no. And I guess interesting results. It is an important factor, but maybe not the most important factor. So let's go ahead and continue. One of the things that I wanted to, of course, I'm a college professor, so I think about this is one of the important points whenever I talk about unemployment is I like to talk about college graduates and young people, and again, both because that's the business that I'm in, but also because of the importance of the education sector to the Western New York economy and to the nonprofits here. One thing that I want to show you is that I want to make two comparisons here. First of all, the young workers here and the college graduates here in terms of the unemployment rate. And there's always been a difference between college graduates and all young workers. But during the pandemic, and again, beginning with the second quarter, what you can see is that the group that really suffered the most from this was young workers. Okay, so that young people without college degrees had by far the largest unemployment rate, almost 23%. College graduates who had been at a quite low level of around 2%, that spiked. Hiring was put off. And for a lot of places, because the workforces, you just couldn't, offices were closed, those sorts of things. That has dropped down now to 5%. But what I want to point out here has been the increasingly large disparity between the fate of college graduates and non-college graduates. And so I've got some other slides that talk about the differences in wages, but just in terms of being able to find jobs, it is increasingly difficult for people without college degrees to be able to find jobs. And a couple of different reasons for that. It's both the nature of the industry here, and especially what's been happening in tourism and travel and other types of things. But we'll have a chance to talk about that in just a bit. Well, let's look at, we know that we've come out of a difficult quarter here, and one of the things that we can do is we can look at employment level to kind of give us an idea about where the gaps have been. So which industries, and so what this does, this slide from the Bureau of Labor Statistics kind of focuses on who has suffered the most. And not surprisingly, leisure and hospitality has taken the brunt of this. Payroll employment levels in the leisure and hospitality group. This is here, in some cases, down almost 65%. And so with a drop in travel, we can certainly think about this with some of the local companies and industries that we have in Western New York, like Delaware North and others. I'm up in Niagara Falls, and we see that with the hotel and tourism. So it was a very, very difficult time for them. The second largest, not surprisingly, and I don't think people will, this is going to be retail trade. So if we look at retail trade and we look at leisure and hospitality, two areas that are very, very important to Western New York. Retail trade, with the closing of the border and the loss of Canadian shoppers into Western New York, certainly affecting that, as well as fewer and fewer people coming into the United States to visit the area. That's been very, very difficult. A couple of areas that have continued, though, and that have really, I don't want to say that they haven't been affected, by the pandemic in terms of employment, but that have actually fared better than others is financial services and professional and business services. And I think the story behind this has just been that it's been possible for those areas, for workers in those areas to be able to successfully work from home. Certainly, I can think of, I had a career in banking before that a lot of banks have continued, but that most people have been working from home. And given the importance of the banking sector in Western New York, with M&T Bank and Key Bank and Citigroup and all of those others, having those employees be able to continue their employment but work successfully from home has been very important. Professional and business services, well, accounting firms and others have been able to, I think, more or less successfully transition during this time to work from home model. Education and health services, again, remaining fairly strong in terms of college. Colleges did lose some students over the in the fall semester, but I think the numbers are going to come out. If I look at University of Buffalo and Canisius and Niagara, somewhere around a 3% loss, which is a lot less than some people had been fearing. I think there was some talk about that could be as high as 15 or 20%. So there were fewer students, but maybe not as many fewer as some people had feared. Manufacturing continued here, and some other areas here. Construction, there were a number of construction shutdowns. Well, here's one of the slides that I wanted to put in because I found it really fascinating going back and looking at, as I mentioned before, that labor force participation rate. And we saw that dramatic labor force participation rate drop. And just looking at those numbers, what that's translating into is about a loss of about 8 million workers there. And one of the things that we want to do is try to explain, so why are there 8 million fewer workers? And this is, I think, interesting, a very dramatic difference. So why are people out of the labor force? Well, some people are out of the labor force because of vacation. Take a look at this here. This is the blue line, childcare problems. Childcare problems are accounting for, at the right now, or at least at the height of the pandemic, about 4.5 million fewer workers in the labor force because people don't have adequate childcare. That has gotten quite a bit better, but still, look at this, still almost 3 million people out of the labor force because of the inability to be able to arrange successful childcare. And so I don't know if that rings true to any of you, but certainly it's something that I see with people that I work with, and it's really one of the major factors that's going to influence how quickly the economy recovers next year. And childcare has been one of those things that certainly, talking about education and school shutdowns and remote learning and that sort of thing, that is going to be a dramatic effect on how quickly the economy recovers. And so I think that many people have a personal experience with this, but I just want to talk about the aggregate effect on the economy. So these numbers have actually been trending up a bit because of that, but we're somewhere around 3 million to 3.5 million fewer productive workers because of a lack of childcare. Well, inflation. Okay, that's our next topic here, is to talk about inflation. I always like to talk about inflation for two reasons. Inflation, because of course the what we pay for goods and services, what has to come out of our paycheck, but also because it's inflation that's going to really affect whether or not the Federal Reserve is as accommodative as it's been in terms of monetary policy. Remember that the Federal Reserve has a dual mandate to try to seek both full employment and also reasonable prices. And there has not really been any worry there, and there's really almost no expectations of an increase or a pickup of inflation. Right now, we're talking about inflation expectations of somewhere around 2.5%. Let me just focus here and unpack some of the reasons why inflation has been so low. So let's start with the total course CPI, which is consumer price index. And so if we take that, what this does is to take out food and energy, which tend to be the most volatile components here. So we've got a much lower inflation rate that we had. What are some of the things that have been driving that? Well, it's not been services. Services have come down a bit, but services are still remaining fairly high. It's been core goods. And so a couple of things that have been explaining this core goods. And one of them has been, I think, what people have been calling the Amazon effect. And that is that increasingly we've been shopping at shopping online, and there tends to be more price competition online for core goods. And so as we shift over from a more brick and mortar retail trade to a online environment, there seems to be more price discovery, more price discrimination there. We don't tend to have that much in services here. Just a couple of other things that have been affecting that. If we go back and look at some of the things that were important, and energy continues to decline. And I think we all recognize that. It's time right now for our second poll, and we're going to start talking about the way that this is affecting investments and in the stock market. But before we do that, it's time for our second poll. And our second poll is, are you fearful that the pandemic will have long-term impacts on the stock market? So why don't you take a minute to answer that question?
I did launch the poll. Just a caution, we are about 8 minutes out from the end.
Okay.
I'll give this a few more seconds and then I will end the poll for everyone. Okay, I will end the poll and I will share the results.
Okay. Well, interesting. Okay, so it looks like we got about 60% yes and 40% no.
Okay, you can move on, Ed. Thank you.
Yep. People are hourly earnings continue to increase. Here's what I wanted to show. And again, this follows up on some of the information that I had before on retail sales. Personal consumption expenditures, excluding gasoline. And again, we've got a number that dropped so much during the second quarter, it didn't even fit on the slide. Interest rates. interest rates are the lowest they've ever been in United States economic history. Okay, we've never had this. The interest rates have moved up a little bit, but still during the summer, we had a 10-year treasury that was right around 0.67 basis points, 67 basis points. It has never been that low before. We are in an era of historic low rates, and that is affecting the economy in terms of making it, I think, more difficult for people who live off of fixed pensions, retirees, and others who would typically be invested in the bond market, but means that there is money available here. We're going to talk about housing in just a minute. And if we look at those low interest rates, look at those low interest rates, and if we want to take a look at one of the most dramatic effects that those low interest rates are having, and that's on new and existing home sales. There is a historical shortage of homes. Home prices continue their appreciation. And I think that we've seen mortgage rates, 30-year mortgage rates that are approaching that 3% rate. And that's just something that's really never happened before. This is good news for the economy because as people move and set up new households, here's a chart of housing starts. Housing starts continue a steady progression. Yes, there was a decline, but they continue their steady progression. This is one of the most important things, I think, for next year will be that interest rates remain low and that new households are formed. When people build a new house, they don't just move into the house and bring their old furniture in. Instead, they tend to buy new furniture. They tend to spend a lot of money on other goods and services. So this is going to be one of the things that I think will be a dramatic rise here in the and think about this. And again, I'll ask you to relate to your own personal experiences. Certainly with me, boy, are we spending more time at home than we used to. So not only do we live at home, but for many of us, we work from home now. And so that means that since we're spending more time working from home, and that's a trend, by the way, that most people expect to continue. Even as we come out of the recession, that out of the pandemic, is that people will spend more time at home, and so they're spending more time to upgrade their home. And with the interest rates being low, that's continuing to increase. It's time for our fourth polling question. Have you paid more attention to your investments during the pandemic election cycle than in previous years?
Everyone's answering fast and furious right now, so we'll give it another couple minutes. Gonna give everyone a few more seconds and then I'm gonna end the poll. Okay, I ended the poll. I will share the results.
All right. Oh, looks like about halfway. All right. Okay. Well, let's take a look why some people certainly have been spending more time. And so we've got a stock market that just recently, maybe again today, has set an all-time level of the highest stock market that we've ever had. And so as measured by the S&P 500 index, we can see that, yes, there was a dramatic drop of about of almost 40% in the level of the S&P 500. That has recovered, and right now we are at historic highs. there. So for people, for that section of the economy that has the ability to be able to invest in the stock market, along with increasing home price appreciation, the value of portfolios, retirement portfolios, investment portfolios has increased, as well as lower volatility. So volatility has gone down, the markets have gone high, interest rates have remained low. And so the point here has been that for people that have been able to participate in the economy by being a homeowner and having investments in the stock market, those people have done very, very well. Conversely, people that do not have the opportunity or have not had the opportunity to own their own home or to have investments in the stock market have not fared as well. State and local consumption here, and again, the story here, and I guess this is we're just about out of time here, but the story here has been federal government expenditures have been increasing, dramatically increasing. State and local expenditures have been decreasing here, and I think that that's going to be one of the central stories for next year, to the extent to which a stimulus bill includes aid for the state and local governments, I think is going to determine that to a large extent. Sarah, how are we doing on time?
I think we are right about at the end of our time that we have. I don't see any open questions that haven't been addressed yet, but I think if you wanted, the next session starts at 10. So if you wanted to take a couple of more minutes, Ed, to be able to wrap up, I think you have a little time there.
Yeah. Okay, great. All right. Okay. So yes, just a couple of things here, talking about the local economy here. So the things that have been driving our local economy over the past 2 decades, really, and it's been the story of Western New York. There are really three different sectors that have affected the local economy the most, and the first has been healthcare. And so we've got a large investment, a local investment in the healthcare economy that looks like it will continue to be strong. There is increased spending here. There is a lot of investment that will continue to be made in healthcare. That's an area that I think will continue to be strong. Education is our second major contributor to the growth in the economy that we've had. And this has been with the growth primarily of higher education in the Western New York area. And I think that that is really one of the areas that maybe is most uncertain for next year and the upcoming year. My university, Niagara University, we were able to remain in person until the last couple of weeks. And then with the infection uptick, we had to switch over to all virtual. A lot of other institutions of higher education in Western New York were able to stay in person. I think to a large extent, that's going to determine, they're going to be determined in the spring. So we'll see what happens in the spring. But hopefully if the virus, the vaccine rollout progresses the way that it's supposed to, I think that economy will, that sector of the economy will remain strong. The other area that I think is going to be most vulnerable, though, continues to be the hospitality and tourism, the leisure area, restaurants, and other types of things like that. So again, I think people are beginning to look sometime towards the second quarter of 2021 for that to be recovered. But it's really a question of how long can many of these establishments last. Can they make it through until that time? And will there be an additional stimulus program, fiscal bridge program like the PPE that will enable those businesses to at least stay together until sometime in the second quarter, the third quarter?
Okay, I think we can wrap things up here. Sarah, I'll turn it back over to you.
Okay, well, again, thank you everyone for attending. We wish that this was a normal year and that we would be there in person, but again, we're very pleased that we're able to do this virtually. And thank you so much, Ed, for joining us again. You're a wonderful addition each year to our Exempt conference. So again, Ed, thank you so much.
Thank you, Sarah. And I'm looking forward to doing it next year when I can say, boy, wasn't that a boring year, 2021? So I like some excitement. I like some change, but no more 2020. So
We agree with
thank
you,
you,
Ed,
everyone.
and we're gonna take you up on that offer and already schedule you for 21.
Okay, good. I hope it'll be boring.
Great. Thanks, everyone. Take
Bye-bye.
care.
Thank you.